Welcome to the daily update, where I'll go over the action in the market for Friday, February 11th, and then look how things seem to be lining up for Monday, February 14th. And I have to confess, this is take 2 of this video. I recorded it before, but I ran into some technical problems. And if I start coughing and hacking right in the middle, well, that's just going to happen because I can't edit these right now. So I ask your forgiveness in advance for that. But it ended up being a pretty negative day on Friday. If you wanted the market to go up, if you were seeing what I've been talking about in the videos, we had a really good chance at shooting higher. Well, that's not exactly what happened. There's a lot of negative geopolitical news out there right now that's really having an influence on prices. And for right now, that seems to be driving the market. We're still okay as far as the technicals are, but if we keep going down much further than this, everything's going to shift over and look more negative. So if you wanted the market to go up on Friday, if you were looking to go long, if you were bullish, you're probably pretty disappointed. Now, that being said, not a lot has changed, and I'll go through and explain what I'm talking about. Incidentally, this video will be longer than the usual videos, and I'm putting this up on the weekend. This is the Friday information for Monday, and I'm noticing a lot more people watch these videos on the weekend. That's why I'm going to put more information in this. For those of you that just watch this video on the weekends, I would really recommend that you watch the other videos. I try to do a video every day, and that would really help cut down the time on these. If I don't have to go back and repeat things that I've said before, if you follow the videos that I put up there and you keep in touch with the context, then I don't have to go back and say things more than once. So, and plus in the future, I'm going to be pulling these things private. So they'll be put up on YouTube after other people get to see them first. So it really would be to your benefit to watch all of the videos, especially I'm uploading them right now, right after I record them. So I've been doing this a long time, and I feel I have some really good insights to offer people, but you have to take advantage of what's out there. So there, end of sermon for that one. So let's go through and see how things look for Monday, February 14th. First, we want to talk about what happened on Friday. We did have a flat open. There was some initial buying, but kind of the inverse of what we saw on Thursday, where there was a gap lower and we saw buying. Well, we saw things go a little bit higher and boom, it just led to selling. Then as the day went on, we sold down to yesterday's S3 level, and I'll show you that on the intraday chart. And then we drifted sideways for a little bit, and then some talk came out about Russia, Ukraine, some Fed speak, and it just freaked everything out. But there are some concerns right now, and this pushed prices lower during the session. We went all the way down to today's S2, which is right around the 44.18 level. We closed near the low of the session, so that's seen as negative, and we ended up being down 1.9%. Volume was above average, and the markets are currently fixated right now on the technicals, those that use charts to study what's going on. We're seeing a real mixed picture right now. We are still in the middle of earnings season. Inflation is a huge topic right now, and that leads over into interest rates. What are they going to do? What are they going to say? When are they going to do these things? And I'll talk a little bit about that. And then the geopolitical concerns, specifically dealing with Russia and Ukraine right now. We don't know what's going to happen. And that might have led a little bit to the selling on Friday, because we're closed Saturday and Sunday. And if something happens over the weekend, people that are shorter term in this, they don't necessarily want to be caught in the market. So I can understand why people would want to close out some things. So some comments about Friday. The short-term and intermediate-term breakout that I was talking about pretty much all week, that's failing right now. We saw a lot of things coming together, and there was really justification in the charts for things to go higher. There's only one problem. They didn't. So no matter how much we study these things, no matter how much we pour into this, we still have to follow what actually happens. No matter what our logic will tell us, we have to follow price. The one thing to be aware of is don't give up necessarily that we're going lower from here. About the time that you think, oh, well, I don't really know what's going on, I'm just going to go ahead and switch over and get out, or I'm just going to go short, forget this whole breakout scenario. That's about the time when things do end up shooting up. So, but at the same time, we have to respect what's going on. If prices just tank from here, we have to switch over and respect that. We can't fight against those things. So that's why I have a lot of different charts, a lot of different things to talk to you about. I really don't have a conclusion right now for Monday. I'm pretty mixed. You could say half full, half empty, and be justified either way. So I'm kind of like a lot of market participants. They just wanted to say, let's go home, watch the Super Bowl, enjoy the Valentine's Day. And even though there's not a lot of love being shown all over the world, and come back and see what happens next week. The market is still overvalued, and we will be in that shape for quite a while. As far as our trend, as we're turning back down, we're seeing the trend strengthen slightly. It hasn't really gone full bore strong yet, but it is strengthening. Our bias now, which is the shortest term, usually if we have an up day, the bias is positive. If we have a down day, it's negative. It's negative because we had pretty solid back-to-back down days, Thursday and Friday. We have to look at that in context, though. I know everybody's freaking out about that, and all the doom and gloomers are just partying like you wouldn't believe. Let's look at it in context and see what we come up with. The momentum is mixed. That's a little longer term. That's some of our short-term indicators that we look at for momentum, and even into the intermediate term. But it's mixed, but it could be weakening. So let's look at the day's session. First, sentiment. We're not showing a lot of fear or greed at this point. That would really help. If everybody was all freaked out, we would be pegged all the way over to the left. And that's not what's happening right now. Here's the chart to give you some historical context. We're midway at the current time. Then looking at the VIX, as we go down, fear goes up. So on a closing basis, we see the VIX going higher, both on the closing chart and on the bar chart. We closed in about the middle on Friday, but still we're seeing fear really spike up. Then the VIX of the VIX, that really shot up as well. So this just says there's a lot of hedging going on. There's a lot of fear in the markets right now. And this could go higher. If we're going to tank from here and go down, this could spike up both on the VIX and on the VIX of the VIX. As far as the sectors, tech got hit the hardest, down over 3%. Consumer discretionary, the things you don't have to have, and I'll talk a little bit more about that later. It was down 2.87%. Communication, and then the couple of areas that were slightly positive, utilities were up a bit, and energy, which of course you feel that every time you go fill your car with gas, that was up almost 3% on Friday. Looking at all of our different sectors, since the high set in early January, energy has been really outpacing, but we have to look at that in context. And I'm going to show you some charts later on that talk more about that. And I'm also going to look more at discretionary and staples. As far as inflation, we had the big report. CPI came out on Thursday. This is what's freaking everybody out. Yeah, they expected it at 7.2, 7.3%. That's high enough, but it came in at 7.5, and that just freaked everybody out. But the interesting thing about this, the red or yellow line, or if you want to call it orange, this is the official number. This is the number that we were given, and it's right at about 7.5%. But if we go back to how this was calculated in 1990, back when Ross Perot, you heard about him, when George Bush Sr. was president, before Bill Clinton came into the picture, how we calculated the CPI then, if we took that same method, we would be up around 11 or 12% inflation right now. Okay, it gets worse here. If we go back to 1980, and do it the way they calculated it back then when Ronald Reagan was coming into office, we would be up between probably 16 or 17% right now. That's 1970s inflation. Okay, it's pretty stinking crazy out there right now. For those of you that grew up in the 70s, you know what I'm talking about. We had stagflation, super high interest rates, zero growth during that time. And people are starting to fear that. And we have generations now of investors who've never been through that. They don't know what it's like to go through that. They may have read about it in a history book, or they may have been told about it, but to really experience it, they haven't done that. A lot of money managers on Wall Street, they don't know what this really means. So this could really have some implications. Then we look at the BDI, and this is something that I follow every day to try to get some insight as to inflation. That really ticked up on Friday. It ticked up Thursday and it ticked up again on Friday. But this looks like it's reacting more to what we already know. So a few years ago, I read an article that said, hey, this is what you ought to follow for inflation. So I put all the stuff on here and started following it. And I don't really know if this is useful or not. Now, some other things, and I went over this in some videos earlier this week. This comes out from the Fed. It's called Fred. So meet Fred if you've never seen him before. This is the Chicago Fed National Financial Conditions Index. So if things are really going in the toilet as far as the American economy, we would expect these things to just be spiking up. Back in the mid 70s, yeah, things were looking pretty stinking bad. This kind of coincides with the bear market of 73, 74. And if you know your history, and I'm a history teacher, so I grew up during this time, we had a president who had to resign. We had massive interest rates at that point. We had massive inflation. We had high unemployment. It really sucked. And then we elected another president who made things kind of even worse. Whether you liked him or not, history bears that out. Okay, so then we come into 1980s and into Reagan territory now. We still were spiking up pretty high. We were able to come down from that. And usually when we're above this black line, that's negative. When we're below this black line, that's positive. It really didn't get picked up in the 2000 dot-com boom and bust. So this chart really didn't tell us much then. But man, this thing sure told us an awful lot in the financial crisis. Yeah, it really spiked up, came back down. And then the last time it spiked up was with the COVID plunge. Came back down. Look at where we're at right now. Does this chart indicate that the American economy is falling off a cliff? Now, we don't want to look at just one chart, but no, things don't look all that bad. You'll find that in the markets, the bond market people, the credit markets, they tend to be more educated. They tend to be more knowledgeable. They tend to deal with more real information, where a lot of times in the stock market and really in the Forex and crypto markets, you're getting a lot of new people that have no idea what they're doing and they're just trying to make a quick buck. Well, the people in these markets, they tend to be very well educated and very well experienced. So that's why I really pay attention to the bond market. And another chart, this comes out from Bank of America. This is risky loans versus not so risky loans. And what is the chance of the risky loans going belly up or people not being able to pay? Well, we go all the way back into the 90s and coming up into 2000, this went up a little bit, came back down. Then we really saw this thing skyrocket in the financial crisis, came back down, went up a little bit, 2015 into 2016, went sideways. Here's the COVID plunge, coming back down, and look at where we're at now. So it doesn't really look like these guys are freaking out all that much. We watch this all the time. Sometimes this data can be a bit delayed, but we want to keep an eye on these things. This is the bond market. We're in the stock market. This is part of intermarket analysis and why we pay attention not just to what's going on in the stock or in the stock market. We pay attention to everything we can find. All right, Fed Watch. I was reading through some stuff after the market closed, and they said that it's gone back down to 50-50, whether are they going to raise it 0.25%, 0.75%? There's even a few saying 1%, blah, blah, blah. It hasn't updated on the chart that I'm looking at. This is what I could find. So I'm not seeing that based on what I was reading, but look for this to possibly update because there's a lot of uncertainty right now. So we'll just have to see how that plays out. Then one thing to be aware of on Monday, Valentine's Day, spread the love. The Fed has called a closed board meeting for Monday. Now, do we all freak out and say the end of the world is coming? They had one in January and they decided not to do anything. The Fed does not have to meet only at the times when there's a schedule. Yeah, they meet about every 6 weeks, but they can meet any other time in between that if they deem it necessary. They can raise or lower interest rates at any given time if they deem it necessary. Well, because of all the freak out that's going on, and we still have to wait till the middle of March, that's over a month from now, until the next meeting, they decided they better get together. Well, now there's a lot of speculation. Are they going to raise interest rates sooner rather than later? Are they going to wait until the meeting? Are they even going to do it in the meeting? What other financial and economic reports are going to come out that may tip this one way or the other? Just be aware of this. And I'll try to dig in and see if I can find any information on what happens. This is a closed meeting, so it's not like they're going to come out and do a press conference after this. But if they do raise interest rates, you'll know that right away. So don't get caught off guard if something out of the ordinary does happen, either on Monday or soon thereafter. Now, another thing is, a lot of people say interest rates up, stocks down. Well, at this site, this is, I don't have it on here. There should be a web address on here, but this is something you can Google this. Google S&P 500 during rate hike cycles, and you'll get what I found. But this tested the theory that as interest rates are going up, what happens to the S&P 500? Well, we go way back over here to the mid 90s. Interest rates were going up. That's this blue line. Look at, we had a 20% return in the S&P. Then in the mid 80s, at 1988 or so, interest rates going up, we had a 44% return. Then 1994 into 95, interest rates going up, we had a 4% return. 2000, yeah, right at the dot-com burst, we were going up with interest rates, we had a 13% return. Then let's see, 2004 into 2000, up until the financial crisis, they were raising interest rates all the way, and we had an 18% return. Then everything went down to zero for the financial crisis, stayed zero for a long time. This is what you call quantitative easing. The market's going up, interest rates are flat. Then they started to go up again. And this is when you had Donald Trump sending out tweets going, what are you guys doing in the Fed? Because they're an independent agency. They're not supposed to bow to political pressure. Now, that's a big debatable thing that we can talk about sometime too, but let's just pretend they're independent of all this stuff. Interest rates were going up. We still saw a 28% return in a rising interest rate environment. Now, could it be a little different this time? And that's one of the most dangerous you can say. If you ultimately come down to the conclusion, well, this time it's different, there's really nothing new under the sun. But we are in a bit of a changed environment because we're coming out of a complete lockdown, shutting down the entire US economy. Interest rates are at zero, okay? And the market's just been skyrocketing. And you've got a lot of manipulation, a lot of policy out there, modern monetary theory. Then if you've heard anything about the Great Reset, if you've heard all these different things that are going on that have been really pushing things higher while interest rates have remained flat. So yeah, this could be, they say that history doesn't necessarily repeat itself, but it does rhyme. So we want to look for what we can take out of this and then make our decisions based on that. Okay, technical alerts. We had a lot of them and they were mostly negative. I start kind of at the bottom. The Nasdaq first, it started out by crossing above 14.4, then it went down to 14.1 and 1400 and 13.9, 13.8. Wow! Okay, so that was a bad day for the Nasdaq. The S&P, it crossed below 4,500. And that's really the only signal here. The ones that are green up here near the top, those could be kind of seen as a little more negative right now. Energy hit a 4-year high. Gold crossed over if you're investing in gold, but this is on a weekly basis. They have a weekly moving average crossover. That's a golden cross. Oil's at a 4-year high, then oil also closed above 90. So some of the things that are feeding into stocks going down, they show up as green because they're just basing it on a technical signal. Okay, let's look at the chart. From Thursday to Friday, we didn't have much of a gap. Looks like we were trying to do some buying right off the bat, but that didn't last very long. We drifted sideways, then went down to the S3, which I don't usually calculate. That's what this black line is. This is the S3 for Thursday. We came down, danced around that for a little while. Then some news started coming out about Russia. Then some Fed stuff came out saying, well, I think we're going to be open to a 50 basis point move in interest rate. And the market just freaked out and went all the way down to S2 for the day, danced along this line and closed right about at the lows. So it was a pretty stinking negative day, especially on the heels of Thursday. We saw some real strength coming in at the open on Thursday, buying into weakness, and then a lot of late day strength. Here we try to see a little bit of buying, but then we just pretty much rolled over and died. So now you could take these in complete isolation and say, oh, everything's going down. It's terrible. It's awful. Well, let's look at it in context as we go through this. You can see right here, we did come down below the pivot, but we're just right back down into where we were before. So it's like we're saying hi to old friends right now. We're just pretty much chopping sideways. So yeah, Thursday was bad, Friday was bad, but we're just where we've been recently. So on just looking at this bar chart, is that really negative? It could be if we continue to tank from here, but this potentially could be very recoverable, at least from what I'm seeing. We are down 7.88% since the all-time high set in January. 10% is correction. We don't really call this a bear market until we get to 20%. And I don't really pay attention to those things too much. I just look at the charts, but this is what the media likes to do, to put nice round numbers and nice easy definitions so that they can come up with their headlines to get attention. Okay, we did see a decline in growth and an advance in value a bit on Friday. Then here we have the growth index divided by the value index. Growth is really taking a hit, and yeah, you can say that. But we're bouncing around a lot here. There's a lot of indecisiveness. And it depends on what day. You know, we could come out Monday and everybody says growth to the moon, but then Tuesday it could all change again. Okay, Nasdaq 100, which is heavily has tech stocks, it really declined in comparison to the S&P 500. If in a real high moving environment, you want to see growth stocks doing really well. Well, they're not right now. And growth meaning tech. As far as our trend, this is what I'm talking about with the ADX. Yeah, it's been trailing off, but it turned up ever so slightly on Friday. It hasn't crossed above this moving average that I have plotted on here, but we're seeing the red line go up and the green line go down. So if this red line starts to go up and the ADX turns up, that means the trend is negative. Then another thing that we've been watching is a thing called the mass index. This doesn't tell us the direction. This just says that something big might happen. We went above 27. That's signal number one. Now we're looking to come down to 26.5. That's when an actual signal is generated. And whatever direction we're going in at that time, look for a reversal at that point. You can look back here and see that sometimes this generated an upward movement, sometimes it generated a downward movement. The decision point, which I use a lot of their charts, their trend models are neutral based on short and intermediate term. Long term is still positive. The PMO, the price momentum oscillator that I rely on more heavily, short term, it turned positive this past week, but intermediate term, it's negative, and longer term, it is positive. As far as our breadth, we're seeing a decline. based on price and volume. It wasn't as bad as Thursday, but it still wasn't anything all that nice. We're rolling over based on price. We've already rolled over based on volume. And you would expect that because for the last year to year and a half, it's been a handful of stocks, even in the S&P 500, that have driven prices up. And so other stocks that are showing weakness, that's why we're seeing a negative divergence right here. Then here our advanced decline ratio, because we had 2 down days in a row, this has dropped below 0 and is negative. Our new highs and new lows, look at this though. We still had some new highs generated on Friday, not as many as on Thursday, but this continues to advance and our moving average continues to advance. The accumulation distribution, okay, we're turning over, give you that, but we're still above this red line. It won't really be negative until we cross below that, and then the red line starts to turn down. Our short-term indicators, we lost the 20. We had been above it, dropped below, both for the simple and the exponential moving average. Our other moving average study declines across the board with the 20, 50, and 200-day moving averages. Our other moving average study, yeah, we sliced right through all these. We lost the 200-period simple moving average, but we're still slightly above the exponential moving average. Okay, the MACD, yeah, it's positive, but it's rolling over. Our short-term trading oscillator, it's showing a decline based on price and volume. And if I'm sounding like I'm going fast, it's because I recorded this video and it was almost an hour. I'm trying to cut it down if I can. The McClellan oscillator was negative. It dropped below 0. Then we have a couple of really touchy indicators here. The Stoke Rsi, it's coming down off an overbought reading. And the Williams percent, it's also coming down after giving a recent overbought reading. Then this is a new one, the force index. It's a little more touchy. We go up 1 or 2 days. This is green. We go down. It's red. I have some Keltner moving average envelopes around here just to kind of give us some context of where we're at. They're similar to Bollinger Bands. Intermediate term, 50 period. We were up above the 50 period exponential moving average. We lost that. We're down below. Then this is what I pull out when we're going sideways. This is a 100-period moving average. We're dropping below. Our PMO, it's positive, but rolling over based on price and volume. So we get another day or two of some downward pressure, and this positive backdrop that I've been talking about for the last number of days, it'll go away. We need to see some follow through with prices. Then our other PMO study, those that are generating buy signals, is declining. Okay, let me back that up. Those that are rising is declining. Those generating buy signals is turned over. And those that are above 0 is flat right now. Then the BPI. We didn't see much in the BPI on Thursday, but we did see some selling. These are stocks within the S&P 500 that are generating a point and figure buy or sell. When this line goes down, that means there's more sell signals. When we look at the S&P P&F chart itself, nothing has changed, but these are stocks inside of the S&P. Our rainbow, yeah, we're still kind of in the middle, dancing around here. We're in danger of this really crunching up and rolling over if prices really continue to fall. Stochastics coming off of a short-term overbought reading, intermediate term overbought, and rolling over a bit with the full stochastics. Summation index, because the McClellan oscillator was negative, the summation index is rolled over based on price and volume. Our momentum oscillators, and I kind of have these in a weird order. The shorter term ones are at the bottom, and they're starting to roll over a bit. The intermediate term ones are on the top, because that's the time frame that I personally look at the most. And yeah, it's rolling over a bit, but they're still positive. The longer term ones have crossed positive and have yet to keel over. The CMF, I only show this because we're still positive even after declining the last few days. Then this is another one too, the praying bottom fisher. This one is really good at picking market bottoms. And I know that sounds disgusting, but we want to look for a crossover. And we had that a couple of days ago. And this is continuing to advance in spite of what we're seeing in price. It doesn't mean it's going to happen right away, but look back in the past. This goes back just a year. And when this has crossed over, that usually has led to something nice in the aftermath. Is it going to happen now? It could. We have to look at our charts and have it tell us what's going on. Then this is interesting too. The vortex, even with 2 down days in a row, see on Wednesday, these things were kissing each other right at 1. Well, we're continuing to see the green line, which is buying, go up, and the sell line continue to go down. So this is actually crossing more positive. As far as our different trading systems, the elder system is really, it's turned red and it's dropping. But our SAR, little longer term trading system, the dots are still underneath, which is positive. Some of our different charts, the Heiken Ashi, yeah, it's putting in this negative action that it sees. The Kagi chart changed a little bit. It turned a little bit to red after having been black. But the Renko chart hasn't changed at all. It's not seeing enough of a movement to register any new calculations. But the 3-line break, it did see this downward move. And there's a black candle here to where there was nothing after Thursday. Equi-volume still going up with the ease of movement, but we're just chopping all over the place right now. Point and figure, no change. If you've been watching any of the videos, it's picked up a possible double top breakout, but the chart's just kind of sat here ever since because we're floundering around hitting prices that we've hit before. Then this is another one, and I like Fibonacci numbers and I hate Fibonacci numbers because they're so subjective. If you pick all these other crazy places, you can come up with anything you want. And I was fiddling around with this, and I had a bunch of different lines on the chart. And this one seemed like, okay, maybe this will tell us something. We had kind of a close to a double low here back in earlier 2021, and then a month or so later, and we were able to bounce up out of that. So I went from this spot all the way to the all-time high, and then seeing, okay, we failed down here. I shouldn't say failed. We dropped down here to a little bit over the 50%, bounced up out of that, and now we're back at the 38.2. Take that for what it's worth. I know people just swear by Fibonacci numbers. I see the logic and the reasoning behind them, but they can be so subjective. It's like Elliott wave. You could come up with your own ways of counting the waves, and I don't like to do things that way. I want things more objective. Our long-term, this is the special K, and this thing doesn't change very often, but it's still kind of going up, which is kind of interesting. Longer term perspective, we have not seen this low reading or below the red line since the COVID plunge, and we crossed over, but then we're still starting to turn up a little bit. Then here we have a long-term chart of the S&P. Look at the big picture here. This goes back to 1980. And this is what's happening right now. Does that look like things are just falling apart? I won't answer that. I'll let you answer that for yourself. The red line is still going up, and currently we are still above the red line. There's other times when we drop below that. Of course, that's the COVID plunge. But even in this overall bull market that we saw, there were times when we dropped below that for a while. So does this look really all that scary in the historical scheme of things? Yeah, if you're really in there battling and you're seeing some hefty losses or the market's really going against you, but the overall picture still remains positive until we really drop and then this red line rolls over. Then also looking at a weekly chart, and I have a 50 period moving average on here because there's 52 weeks in a year. Yeah, we've seen some damage, but we're still above the red line, and the red line is going up. Longer term, this is a monthly chart going all the way back to 1980. Same thing, moving average is going up. Yeah, we have fallen back quite a bit, but we're still above this red line. Then this is another one too, the rate of change 200, goes back roughly a year. It's like, oh my gosh, we're down here, the red line, this line, crazy, crazy time. We'll look at it in bigger context. Whoa, that's interesting. This is stratospheric levels that we've been at. So we're just coming down from some very high readings to get more of a context on this chart. This is something I want to point out. One thing that we notice from time to time is this is the 2-year yield right here. And whenever this seems to top out and then turn and go back down, look, this is when we had the dot-com bust, 2008. Now, it doesn't always happen all at once. This can take a period of a few weeks to even a couple of months to play itself out. But this was the top right before the financial crisis. And then 2-year interest rates started to go down. We were able to skyrocket up. And then this is not COVID right here. This was on Christmas Eve 2018. The market just kept going down and down and down. And the market was only open for part of the day that day. That ended up being a significant low. Oh, look what happened. 2-year interest rates had topped out here. The reason I bring this up is we're going to keep watching this. I don't think it's necessarily telling us anything yet, but it is something that we should watch. We're just seeing 2-year rates, interest rates just skyrocket up. If they go up pretty far, pretty fast and start to roll over, look to see that is the time when we might see some real weakness in the market. Now, as long as this thing keeps going up, we can have a more positive stance on things. As far as the broad market with stocks, S&P back into this mess of a range, mid cap also a mess of a range, small caps, which never really got out of the first mess, they're just pretty much chopping sideways. The FANG stocks, this is concerning. At least on this chart, we have a death cross. We had a bad day on on Friday, and then we closed right near the low on Friday. Not really good for high-tech stocks. Then ARK, and I like Cathie Wood. I watch the videos. I respect her. I don't agree with a lot of the things she says, but she has reasons for why she does things. And so she's worth listening to. And I watch the videos where it's her talking, the videos that she does. I don't really care about somebody else doing a commentary on what she says. I can listen to her myself and kind of come up with my own conclusions. But she got smacked about 2.5% on Friday. The Dow dropped below the pivot line and we're below the 200-day moving average. That's negative. Small caps, we were at the pivot, dropped down below. We're seeing a crossover of the moving averages. Similar thing with the mid caps. We dropped down below the pivot and we're starting to cross right now with the moving averages. The Nasdaq, yeah, we danced around a couple of times at this pivot level, but ultimately dropped down below that. But look, we're right back into familiar territory here. It's like a reunion or something. The Nasdaq 100 dropping down after trying to get through this pivot point for February. And the Vixen, this is the VIX on the Nasdaq 100. As prices fell, we really started to see fear increase. NYSE holding up a little better. There's not as many tech stocks in here. We're still above the daily pivot. We're slightly below the 200-day moving average, but we haven't dropped down below the pivot at least yet. Then the Wilshire, it's looking a little worse. We did drop down below the pivot point on this one. Looking internationally, China, it's kind of topping out a little bit. It's kind of hard to see that. And then with them being closed a week, that just messed things up. Emerging markets are trying to turn up slightly. Europe trying to turn up slightly. Japan trying to turn up. And the S&P trying to turn up. And this indicator is the KST. And it tends to move a little slower than a lot of the other indicators that we use. Then to take all the stocks together, well, we've been bouncing around in between these moving averages. We really fell, came back up to the 200, broke down, then went up to the 50, broke down. So we're just playing bumper cars right now with moving averages. This is intermarket analysis, and I do that I do this throughout the whole video, but this just shows you going back 1 year. Oil just been screaming, and you could really start calculating this since the first of the year. That's really when it started to take off. The S&P is kind of bouncing around a little bit. The dollar's been going sideways to slightly up. Gold had a bit of a turn up in price that I'll talk about a little later, but bonds, it just kind of from a price perspective, if you're trying to buy low and sell high in the bond market, you're not very happy with the way things have worked out. The broad market, the dollar had a pretty good move back up above 96 on the daily chart, and a pretty decent recovery to just above this blue moving average on the weekly chart. Oil, we're up around 93 now, so you can feel it every time you go get gas. Gold had a bit of a move up, but still we're back here to where we've been before. Silver, similar story. We had a good day, but we're just kind of floundering sideways. You can call it consolidation. The CRB, which I use a lot to kind of get some ideas of inflation, we've really been seeing a run up in this, and it was up slightly on Friday. Bitcoin, I just kind of like to look at this, just, I don't know why. Okay, then bonds, this is one thing to be aware of. This is called the credit spread, and it's the spread between the 10-year bond rate, interest rate, and the 2-year interest rate. And we're really seeing this thing fall. Where we really start to get a little concerned is when it drops below this line, because that means there's an inverted yield curve, and that might signal a recession. Now, there's another credit spread chart that I have here, this next one, where again, there have been times when this showed that we were going to possibly have a recession, but right now it's just really not helping us. It's shooting up higher, where the other chart is actually going down. Looking at interest rates across the board, we saw declines in the 30, 20, and look, these things are almost kissing each other right now. We saw a really big decline, or it's been going up, but then a bit of a decline in the 2-year. But look at how this 3-month has just been shooting up. Now it dropped a little bit on Friday, and that didn't even seem to give stocks much support. With interest rates going down, stocks should have used that as something positive, but they chose not to do that. Internationally, the US is still doing the best. German interest rates now are back to being positive. And this is why a lot of world investors buy US bonds. If you had to choose any one of these interest rates, which one would you choose? The green one, the US bond. And that has helped to keep prices lower. Looking at bonds on price, remember there's the interest rate and price, and they move in inverse relationship to each other. We were up a bit on Friday, but still the overall trend has been down. So if you bought bonds with the idea of buying low, selling high, you would have been better off shorting bonds. The corporate bond index that we look at, it bounced up a little bit on Friday. And that's based on price. Now, let's look at some of this. This is energy versus the SPY, which is the ETF based on the S&P 500. Okay, looking at the daily chart, yeah, we're going down, overall downtrend. Well, we're turning up ever so slightly, and price has really been shooting up. Okay, that's on a daily chart. This is what it looks like on a weekly chart. Also a downward, a pretty hefty downward trend that really kicked into gear in about 2012. So we're going to have to overcome some pretty big obstacles for this thing to go above the red line and have the red line turn up. And then monthly, kind of the same thing. An overall long-term downtrend. We're coming right up to this moving average now. Then looking at tech versus the spiders. Yeah, tech has been getting hit pretty hard. And if we drop below this, that'll look even worse. But right now, we're still above the red line. So even though tech has had some weakness, Doesn't mean we're just falling off a cliff, at least yet. Then tech versus the S&P, looking at a weekly chart, yeah, we've had some damage, but we're still above the red line. Monthly chart, same thing. We've had some damage, but we're still above the red line. Then gold, this is kind of interesting. This is how, if you had bought gold and you had bought S&P at the same time, which one would have performed better? Well, this is gold divided by the S&P, and you would have just not been happy. Now, not everybody that buys gold wants to buy low and sell high. They just want to buy it. In fact, they like the idea that it's falling because they can buy more. They're not trying to trade it. They're not trying to buy low and sell high. They just want to have gold so that if they need it at some point in the future, gold has always had value attached to it, and it will always have value in the future. So you don't care about this. But if you look at gold investing from a trend perspective, you've been very wrong for quite a while now, unless you shorted it. Then another one is to compare staples, the things you have to have, with discretionary, the things that are nice to have, but you don't necessarily have to have. The top chart is the S&P. This is just measuring the staples against discretionary, and this is discretionary going down, 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 down. Actually, I'm incorrect. This is staples going down, 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 as people are letting the good times roll. Well, we've seen a real spike up lately, and we'll want to keep an eye on this chart. Then looking at this on a weekly basis, we're seeing kind of a similar idea that discretionary was really falling. Now staples are starting to really take over. And here's a monthly chart. Also, not necessarily switched over positive, but it's looking better. Then this has nothing to do with the S&P, everything but nothing. There's no S&P on this chart. On Friday, we had the University of Michigan's consumer sentiment come out. It was the preliminary report. And if you look at this chart, other times when people are feeling better about things, a lot of times that will help interest rates go higher. And when people are feeling bad about things, that will help interest rates to go lower. And then here, 2007, 2008, people were pretty much not doing very good. So we saw interest rates lower. And then 2012 up till, well, that's not the COVID plunge, but the high that we set back in 2019, these two went hand in hand with each other. Well, look at what's happening now. We have interest rates really spiking up and people feeling not very happy about the economy. They're going in opposite directions. When that's happened, that's what I measure down here. When we see these spikes, sometimes, see back here, there's really not much from the 2000, from the dot-com boom and bust. We really saw this spike up in the financial crisis. We saw it spike up with the COVID plunge, but now we're seeing it going even higher than that. People are not really happy about what's going on right now, and that can have a big impact on interest rates, or short-term interest rates can have a big impact on people's happiness. So what are we going to look for Monday? I have the same question up here that I had for Friday. Can the improving backdrop remain? If we continue lower, that positive backdrop is going to go away. We need to see a follow through with price action. The long-term is trend. Oh my God. The long-term trend is up. Okay, I've been talking a lot today, but showing signs of weakness. We're still in the middle of earnings season. The battle continues between growth and value. There's really no reports coming out on Monday, economic reports. There's the whole situation in Ukraine and Russia. We do have the Olympics, which can become politically charged. And then I haven't really heard much out of the Iran meetings that are happening in Vienna. Are they going to put more oil into the system? Are they not going to do that? And that's been playing around with oil prices lately. So our conclusion, the S&P is mixed. It's kind of hard to come to another conclusion unless you just use one or two indicators. The possible upside breakout is still possible, and I just love that I used the word possible twice. But the technicals will weaken if selling continues. Duh. But We just have to keep an eye on those. The short-term bias is negative, intermediate term is mixed, the long-term bias is positive, but showing some weakness. So please enjoy the Super Bowl, enjoy Valentine's Day. Here's the information if you want to contact me, and I will speak to you again after the session on Monday.